Running a business can feel like driving a car with a dirty windshield, and your accountant is for some reason cleaning the back windshield of the car. So you run your business off of data from individual apps, and looking at all this data is like trying to see through the matrix. So you make decisions with bad information. And you can't figure out why you're not growing and why your cash balance is dwindling. And it feels like you're spraying cash out the muffler to make the car go faster. Fortunately, there is a better way. Hi, I'm John Zanowski, and I'm the inventor of the weekly accounting system, and I'm the co-founder and CEO of the company Weekly Accounting. Our mission is to help everyone see their business better. The most important part of my background is not that I have a master's in electrical engineering or that I went to Harvard Business School, but it's that I was a sonar engineer, not an accountant. Sonars do what people do. They sample data from the environment, they separate the signal from the noise according to a value system, and they make a map of the territory. And it feels like we make decisions from that map. People in business do the same thing. They sample data from the business, but the map they use was invented 500 years ago. That's right. The income statement, the balance sheet, and cash flow, as you think of it today, was first documented when most people believed the world was flat. And since then, all accountants have done is make more rules. So I say a CPA is a license to do your books in a way that doesn't help the business. Weekly accounting is a better map for business. With the system, I built $500 million companies and a $100 million fund. I've helped founders succeed and turned equity into cash with them 17 times. I've written a book called Zen and the Art of Nothing, and it's a system to see business life and reality better. I'm working on the second book called Zen and the Art of Weekly Accounting, and it's about the new map for business that I'm going to describe for you here. This is a section of the book called Seeing Your Business Better with Unit Economics. When you can see your business better, you'll know how much it costs to acquire a customer and how much revenue each customer generates, and how much it costs to service each customer and how much profit you get from each customer. So you'll know what to do next. Should you spend more money on marketing? Do your customers like your product? Is this channel saturated? How much more can I grow? The answer to all these questions depends on your unit economics. Unit economics analyzes your business on a per unit basis. To a sonar engineer, they're like the frequency codes of your business. You can predict the future with your unit economics. Your forecast will be better, and you'll understand the limiters of your growth, and you'll know where to focus your attention. The components of unit economics are complicated, but I'm going to break it down and show them to you simply. The system starts by ingesting data from every business application and normalizing it. We make this common view of the business, focusing on unit economics, and then we show it to you weekly and make forecasts monthly and quarterly. And it works because when you put the right data in front of an empowered team, things get better. Let's start with customer acquisition cost. So customer acquisition cost is a combination of ad spend and orders from new customers. This company spends between $100,000 a month and $200,000 a month on ads. Cumulatively, it has spent $6.7 million on ads since the beginning of 2021. It normally gets about 1,000 customers per month from this ad spend, and recently it's been getting about 1,500 customers a month. Cumulatively, it's gotten 50,000 new customers in that same period. So now we can calculate 6.7 million in ad spend has acquired 50,000 new customers. So that's $134 per customer during the entire period. So this is a cumulative metric. And cumulatives are the signal in the noise. Cumulatives are like a balance sheet for your metrics in your business. So accountants got that right. So customer acquisition cost has ranged between $100 and $175 for this company. But when you add in the cumulatives, you can see the signal in the noise. It fluctuates wildly from month to month, but on a cumulative basis, it doesn't change much. So that's what it looks like when you put it all together. Now let's look at the components of lifetime gross profit, starting with the easier ones, average order value and gross margin. Now that I've taught you this visual language, I'm going to go a little faster. So the total orders for this company has been about 2,000 orders per month, cumulatively about 85,000 orders. I'm going to stop using red to show you the cumulatives. So revenue month has ranged from about 250,000 to 500,000 per month, and it's generated about $20 million in revenue since the beginning of 2021. So its average order value has ranged between $200 and $225 since the beginning of that period. So when we zoom in on the y-axis, we can see that it's grown from 200 to 225. And remember, our mission is to help everyone see their business better, and that's why zooming in on these charts and making them this way is part of that as well. Gross margin fluctuates a lot on a monthly basis because for some reason, inexperienced bookkeepers try to make it accurate in every period. If you were a big company, you would just book the gross margins to a 53% in this case, and you would keep all this noise of your gross margins on your balance sheet like a company like Apple does. So since February, gross margins for this company have been above the cumulative. That's because I met this company in February and I showed them this data and they stopped discounting to increase their average order value. Purchases per customer is a little complicated, and I'm not going to go into how we sample it on a month-to-month basis, but I'm going to show you the 50,000 customers that this company has had have purchased 85,000 times. That's 1.7 purchases per customer. And when you look at that, when you look at it cumulative versus the samples that I take each month, you can see how consistent it is. Zooming in again, you can see that the repeat purchases have increased from about 1.5 to 1.7. But the more important thing is that we made a pretty good guess with just a few bits of data. And that's what a sonar system does. It takes a little bit of data and interpolates the map. So now let's bring it all together into lifetime gross profit. So 1.7 purchases per customer and an average order value of $241 and a gross margin of 52%. That's a lifetime gross profit of $198 for this 3.5-year period. It's grown from it's grown from about $160 per customer to $200 per customer in that period. So now let's bring it all together and look at lifetime gross profit to CAC. So the lifetime gross profit of $198 and a customer acquisition cost of $134 means the lifetime gross profit to CAC ratio is only about 1.5. After seeing the financials of over 3,000 brands like this, I can tell you that 1.5 is not enough to get to profitability unless your overhead is very low. You can see that it had a tough September through January where it was all the lifetime gross profit to CACs were below the cumulative. We talked to them in February and they've been reducing discounting, reducing ad spend, and to reduce customer acquisition cost. And there's not much they can do about increasing customer life. That is a number that the business reveals to you over time. And you can see the impact it had. It was much less profitable during that period than it has been more recently. Repeat purchases in this company have also flattened out. We're seeing that happen with lots of brands. So what's next for this company? Clearly, the ad spend channel is saturated. It's trying to spend too much in the channel and the customer acquisition cost is too high. So we should maximize the contribution from this channel by reducing the ad spend and raising prices or reducing discounts. If this company got its lifetime gross profit to CAC above 2, then it probably has a smaller revenue in this channel, so it'll have to find new channels to grow. So I can do this analysis for your business pretty easily. If you go to weeklyaccounting.com and click in the top right corner, you can connect your QuickBooks and your Shopify, and we'll do this analysis for you. And it'll help you see your business better. Thank you.